Yeah, good evening, everybody. It's great to see so many friends of the department and friends of Ernst here this evening. My name is Ralf Ossa. I'm a professor of economics here at the department, but until last year, I was also the chief economist of the World Trade Organization. So I thought I'll talk to you about the effects of Trump tariffs on international trade. And the first point I want to make is that the change in US trade policy is truly historic. So what you see on the slide is the average US tariff, how it evolved over the course of last year and also the beginning of this year. That's the red line that you see going up and up and up. And I compared that, just to put it in perspective, to the evolution of the average tariff rate of China and Canada, two countries that also changed their tariffs last year. So what you see, of course, is that the US tariffs have really increased dramatically. Now, this is historic, I would say, for two reasons. First, because you literally have to go back a long time in history, all the way to the 1930s, to see US tariffs of a similar magnitude. And this was exactly the last time when a trade war happened, interestingly also initiated by the United States. Now, the second reason it's historic or it's significant is because it's not just any country, but it's the US. And the US, because they had learned from the first trade war, basically built a rules-based trading system, first with the GATT and then later with the WTO. So that it's exactly that country now that is turning towards a more protectionist trade policy stance is, of course, significant. So if you look at this, you might think that this is going to be the end of international trade as we know it, that there's really going to be a collapse in international trade. But then you look at reality, you look at trade last year, so this is what I'm showing you here is the change in the merchandise trade by region last year, so basically growth rates. And you see that despite this tariff shock, international trade, goods trade, has actually been quite resilient. So if you look at the leftmost column, which is the world total, in blue you have the exports, in red you have imports, you see that in nominal terms, international trade last year grew by over 7%. Yeah, some of this is prices, but even if you take the prices out, you still see a healthy growth rate. So nothing close to deglobalization or a major collapse. Now, if you look at the regional distribution, you see a little bit of the impact of the tariff. In particular, you see North America not doing so well, which is what you would expect if you put huge tariffs on North American supply chains. But the rest of the world looks pretty stable. Which then, of course, generates a puzzle. You know, how can it be that we have this historic tariff change, but then trade is doing reasonably well? And there's two explanations. The first one, Esther already spilled the beans, is that the US is actually much less important in international trade than is commonly assumed, and then actually also, I think, President Trump thinks it is. So if you look on the left-hand side, what I plot here is the share of merchandise imports, worldwide merchandise imports that go into the US. So the way to read this is that 14% of all import demand from the world comes from the United States, 86% comes from the rest of the world, which means that the rest of the world is pretty big, all things considered. Which then leads me to the second slide, and this is really the most important one, so this is the one thing I want you to remember, which basically says that the rules-based trading system, or rather that the majority of world trade is still conducted under a rules-based system. So the way to read this is that the blue bar, that's the share, or the blue, it's not really a line, the blue area, is the share of global goods trade that is conducted directly under the tariffs that are negotiated at the WTO. So at the moment, despite all the mess that we see, 72% of world trade is still conducted directly under the tariffs negotiated at the WTO. Then the yellow area is the additional tariff reductions that come about from preferential trade agreements that are also consistent with the rules-based trading system, which means that overall today, 88% of world trade is still conducted on a on the basis of rules, and only 12%, which not coincidentally is very close to the 14%, can reasonably be described as power-based. And I think it's such an important message also politically, because when you open the newspaper, you keep reading how the WTO is dead, the rules-based trading system is dead, it's a free-for-all, it's the law of the jungle. And it's true, of course, when you think about relations with the United States, but it's not true for the rest of the world. That's the first reason. The second reason why trade is doing or has been doing relatively well is, perhaps not surprisingly, AI. So, if you look at the American stock market, you might also be surprised that despite all this economic policy that is being implemented, you see such high valuations. And of course, to a large extent, this is due to the investment boom in AI. And this is also, interestingly, what you see in international trade. So if you think about it, there's a lot of investment in AI. You invest in something, and typically you invest in some tradable good. You invest in a microchip, you invest in some sort of data processing equipment, and so on and so forth. And these goods get traded. And interestingly, that had a significant effect on world trade flows. So what you see on the left-hand side, that's a calculation by the WTO. It says the share of AI-related goods, so goods that are broadly related to this AI investment boom, has skyrocketed in the last couple of years. And what you see on the right-hand side is an estimate by the WTO, which basically says that 42% of the increase in world merchandise trade last year was due to this AI effect. So you basically have rules are stronger than most people think, and also you have this additional boost from AI. But now, of course, not all is well in international trade. I mean, first, there's, of course, the risk that these trade tensions could escalate. So I think, it's not clear that it's going to stay that way. But then, of course, we have all sorts of geopolitical risks that remain substantial. The one that's been in the news, of course, most significantly or most prominently lately has been the war in Iran. So this is why I put these charts up here, which show you the evolution of commodity prices, oil prices, for example, over time. I stopped updating the chart at some point because every day it was like down or up or down or up. Now, of course, it's down again because there seems to be a peace deal. But the point is, of course, that these geopolitical risks are significant. So if you think about the war in Iran, there's two effects on international trade. First, you have the direct effect through the closure of the Strait of Hormuz. About 20% of the world's oil goes through that strait, about 30% of fertilizer, which actually is then also going to have some repercussions on agricultural productivity, food security, and so on down the road. Also, the vast majority of food imports into the Gulf region comes through that strait, so that's another factor. So you have the direct effects. But then, of course, you also have the indirect effects through higher commodity prices, lower demand, and so on. So to conclude, 4 takeaways. We have sharply rising US tariffs, which are a genuine stress test for world trade. Second, even though world trade has proven remarkably resilient to this shock. One reason is that the rules-based trade remains a key anchor of stability, and the second reason is that the AI boom adds further tailwind. And if you want to say it in one sentence, world trade is bigger than the US, which is why its rules are worth defending. Thank you very much, and I'll hand over to Carmen.